another sign that the U.S. economy is proving to be resilient. Official data shows that GDP was up more than expected in the first quarter. In fact, nearly a whole percentage point more than what the original estimate was just last month. Owen Fairclough starts us off.
I'm outside one of the newest retail and residential complexes in Washington, D.C., which perhaps illustrates where the U.S. economy is right now, with luxury condominiums, two-bedroom condominiums, selling for up to $1 million, and Whole Foods, the latest grocery store to expand in the U.S. capital. All of this happening just before the latest U.S. economic numbers were released that suggest that the economy is resilient despite the inflation crisis, with GDP output for the first quarter of this year revised upwards to 2%. That's a big revision from the initial figure of 1.3%. And typically these numbers are revised down, not upwards. And it's exports and retail spending that are proving resilient and help drive those figures higher. Unemployment claims are also falling dramatically, with unemployment nationally at historic lows. And 8 U.S. states, predominantly in the southern U.S., have now set records for all-time low unemployment. So it perhaps suggests why Joe Biden, the U.S. president, wanted to get out in front of these numbers by heading to Chicago on Wednesday to essentially set out his stall to U.S. voters to persuade them to give him another term in the presidential election of 2024. Biden is saying that, yes, the inflation crisis has been bad, but wage growth and the fact that inflation has come down in recent months suggests that the U.S. economy has rounded a corner and is proving resilient. Biden's vision for what he calls Bidenomics is essentially Biden saying that he can build the U.S. economy from the bottom up to benefit everybody, particularly the middle class, with government-led job creation. That's in direct contrast to Donald Trump and indeed Republicans who favor supply-side economics. They essentially think that by giving tax cuts, employers can drive the economy and essentially incentivize consumers to buy more. So these two camps are starting to really take shape as the US head towards its presidential election of 2024, with Biden insisting that his vision of a fairer economy will win, and indeed pointing to those numbers, and Donald Trump, his supposed rival for the presidency, insisting that Biden's infrastructure program and government spending are going to put the economy in trouble. Owen Fairclough, CGTN, Washington.
U.S. stocks fairly happy on partly that news. William Denslow has more on how the NYSE wrapped up.
Well, there was plenty of positivity on Wall Street Thursday. Investors reacting to that better than expected first quarter gross domestic product revision, up at 2%, far better than the previous estimate. So that helped really boost market sentiment on Thursday. The Dow Jones closing the day up 0.8%, the S&P up 0.5%, with the Nasdaq essentially flat. The financial sector, the banking sector, very much in focus on Thursday as well. We've had the Federal Reserve's annual stress test, and the 23 biggest lenders in the United States passed. That was a vigorous, comprehensive review of essentially how the biggest US banks would handle a hypothetical recession. Of course, this all comes in a year that's seen the collapse of several regional banks. So that has helped inject a bit of positivity into what has been a shaky period for the banking sector so far this year. Other economic data out on Thursday, weekly jobless claims falling to a 1-month low. So good news there for the US labor market. And looking at some company news, Micron, the chip maker, they've released quarterly earnings coming in better than analysts expected, but their shares did fall over 4% on Thursday. This after they failed a cybersecurity review in China. Micron says that presents them with significant headwinds. William Denslow, CGTN, New York.
For more on those revised figures on GDP and the economy and everything else, Ken Kuttner, professor at Williams College. It's good to see you again. This, some people are, I'm not surprised. Some people are surprised. We've had this record low unemployment rate, which is helping drive growth. Corporate profits remain relatively strong. Home prices remain elevated. There's a lot of pluses in the economy, but there's all this underlying negativity because of rates.
Yeah, no, it's you're absolutely right. And the introduction, I think, put it well. The term that comes to mind in this context is resilience. The U.S. economy is showing really a level of resilience that I think nobody really expected.
Is it because we are too, as Americans, obsessed with shopping? Like, we can't stop shopping. You go to Amazon. I walk around the computers in the office. People are on Amazon.com. Everyone's shopping. You go into the mall. They're busy. People are flying. People are traveling. I see no slowdown in the places I visit. Now, granted, I might live in a bubble, right? I hang out on the West Coast and here in Washington, D.C., so I'm not in every single city. But just from my vantage point, it feels that people, as long as they have jobs, will continue to shop.
You're absolutely right. There's a lot of strength. Consumers showing a lot of strength. Interestingly enough, a lot of that's coming from services. I haven't dug into the numbers enough to know where that's coming, but I suspect a lot of it is coming from travel. I think the travel industry is doing very well.
Now, and I don't want to ignore the challenges in the economy, but we just came out of COVID. A lot of people are still working from home. I know some are coming back to the office, but there's still a huge segment of the population. And one of the experts was like, well, you know, that's going to be a disaster for real estate. It's going to be a disaster for commercial real estate because look at this building is empty and that building is empty. How much do we need to be worried about these office buildings not having people come back to work?
Yeah, I've heard conflicting things about that. I know there are a lot of sort of localized issues in certain cities. New York City, I think, is having some issues there. Exactly how widespread that is, I'm hard to say. I'm not sure how pervasive that is across the country, but that's certainly something to watch.
The last time Chairman Powell spoke, we left rates unchanged. He was going to look at the data and kind of let the economy simmer, if you will. Then he drops the sort of mini bomb and says, well, there'll be more rate hikes coming, maybe one, maybe two, probably two. And while it was kind of vague, it was specific. He did talk about 2 potential rate hikes. We seem to be kind of ignoring that, but because if we focus on it, then we could probably talk ourselves into a recession. Is recession back on the table or is it off the table?
Oh, I don't think so. In fact, I think it's less on the table now than it was before. The thing to keep in mind is that on an inflation-adjusted basis, the federal funds rate is still not that high. Inflation-adjusted is right around 0, which you could characterize as being approximately neutral. So really, I think what the Fed has done with the rate hikes is less to slam on the brakes and more to simply take the foot off the gas in hopes the economy kind of coasts down to an appropriate speed.
As the professor that you are, if you were giving advice to Chairman Powell about how to, I guess, slow the inflation down while not blowing up the economy and kind of creating this sort of not too hot, not too cold environment, what would your advice be?
Well, I think what he has hinted at is approximately what I do. A couple of more minor rate increases, another 25 basis points next couple of meetings would probably bring the economy pretty much to the sweet spot in terms of spending. But of course anything can happen. As I think Powell himself said, the economy rarely turns out the way we expect. So that's in the absence of some other shock that might come along.
And if you look at the bond market, and there's a couple of indicators that show that there are some things that people are worried about when you look at the economy, say 12 to 18 months out. What's the biggest challenge in your opinion?
Well, one of the things that people have been looking at and often look at is the slope of the yield curve, and that's been the yield curve has become flat or inverted, which tends to precede recession. So it's a little bit confusing picture here. The real economy is doing great, far better than a lot of people expected, but at the same time you have that flat or inverted yield curve, and so that's definitely a mixed signal that is keeping some people up at night.
Professor Kuttner, always appreciate your analysis on this. Thank you.
Nice to be with you.